application paper on climate risk-related market conduct issues in the insurance sector. Iris Curtis and Tom Perkins, both from Bank of England, who jointly lead the IAIS climate scenario analysis workstream. We will cover the draft application paper on climate scenario analysis in the insurance sector. And Hannah von Wulden, head of the supervisory practice and operation at IAIS, will host the Q&A session at the end. So if you'd like to ask questions, please send them using the Q&A box. When sending your questions, please use the all panelists option. And before starting, I would like to mention that the presentation slides have already been posted on our website, and the call is recorded, and the recording will be made available to the public after the session. Beth, please start.
Thank you, Miroslav. So good morning to those of you in the U.S. like me, very early, or good afternoon or good evening to the remainder of you. So we are in the agenda of the public webinar today. We're going to cover some background on the IAIS, who we are, what we do, the IAIS strategy and overall work program in addressing climate-related risks, and an overview of the 2 application papers recently issued by the IAIS. We are then going to open the floor for questions. The Secretary will be monitoring the chat, so please feel free to share your questions in writing if possible. It would be useful if you could indicate who the question is directed to. We will address your questions towards the end of the session. So some of you might be less familiar with the International Association of Insurance Supervisors, also referred to as the IAIS, I want to give you an overview of who we are and what we do. We are the international standard-setting body for the supervision in the insurance sector. As you can see on the slides, the mission of the IAIS is to promote effective and globally consistent supervision of the insurance industry in order to develop and maintain fair, safe, and stable insurance markets for the benefit and protection of policyholders, and to contribute to the global financial stability. Our membership is particularly broad, with more than 200 jurisdictions represented, covering 97% of the world's insurance premium, and represented by 39 members of our executive committee. So climate risk. Climate change is and will continue to be a significant driver for insurers in the coming years. It's a source of financial risk that impacts the resilience of individual insurers and could lead to financial stability risk. As the insurance standard setter, the IAIS is playing its role to promote a globally consistent supervisory approach to climate-related risks. This is why climate change and the associated climate-related risks is a key strategic theme for the IAIS. An adequate response from supervisors to risks posed by climate change supports the objectives of insurance supervision, namely protecting policyholders, contributing to financial stability, and promoting the maintenance of a fair, safe, and stable insurance market. The IAIS has been closely monitoring developments in global climate change mitigation efforts, climate science, and how supervisory practices to manage climate-related risks have evolved. To coordinate the overall IAIS strategy for addressing climate-related risks, the Climate Risk Steering Group was established in September of 2021. The IAIS work on climate change spans across many of its activities, ranging from financial stability risk assessment, developing supervisory and supporting material, and capacity building. The IAIS work will focus on undertaking analysis to understand climate change impacts, promoting a globally consistent supervisory response to climate change, and assisting in capacity building initiatives. The focus of today's session is the second pillar on promoting global consistent supervisory response to climate change. However, if you're interested in our analytical and financial stability work, I encourage you to go to the website to read our latest Global Insurance Market Report, also referred as GMAR, which includes a chapter outlining this year's analysis on climate-related risks. The IAIS is committed to supporting its members to further strengthen our focus on actions taken by insurers to assess and address climate-related risks and to support an orderly transition to net zero. The IAIS has issued several papers and reports on this topic over the years to raise awareness of insurers and supervisors on the challenges presented by climate change and to support the development and sharing of good supervisory practices among IAIS members. One key paper is the initial application paper on the supervision of climate-related risks in the insurance sector that was issued in May of 2021. It provides background on guidance and how IAIS supervisory material can be used to manage the challenges and opportunities arising from climate-related risks. It covered a number of key priority topics, but it was not intended to be a comprehensive overview, and for instance, therefore did not cover all relevant insurance core principles. Since the analysis surrounding climate change is rapidly evolving, the IAIS performed a gap analysis of existing supervisory material in 2022. This was to assess how climate risk is already captured on global standards and to identify possible further work in terms of standard setting and or providing further guidance or supervisory practices. We concluded that the ICPs are sufficiently broad to cover climate risk, but we did plan to make a number of changes to the guidance of the ICPs. In consideration of the gap analysis outcome, the IAIS issued a series of public consultations to seek stakeholder feedback and on limited guidance change related to climate risk. We concluded and we developed supporting materials beginning in March of 2023. So we are now at the second goalpost of the launch of the public consultation in November of 2023 on proposed supporting materials covering issues on market conduct supervision and climate scenario analysis. The next consultation in March of 2024 will cover additional supporting materials and limited changes to guidance related to various topics, including risk management and investment policy. The feedback received from the series of public consultations will shape an updated and more comprehensive package of climate risk-related materials, including updated insurance core principle guidance and updated application paper. The aim is to help supervisors better incorporate climate risk into all aspects of supervision and for insurers to incorporate consideration of climate-related risks into their governance and operations, thereby promoting a globally consistent approach to addressing climate risk. The objective of the application papers are to provide supporting materials. They do not include new requirements, but provide further advice. And the proportionality principle also applies to the content of the application papers. Before we jump to the overview of the two application papers, we wanted to share a status update on the first public consultation in March of this year. To recap, the first IAIS public consultation was issued for comments on May 16, 2023. It outlined proposed changes to the ICP introduction, which positions climate risk within the global framework for insurance supervision. Additionally, it discussed whether it's necessary to make changes to the existing supporting materials related to governance, risk management, and internal controls. Those are insurance core principles 7 and 8. Finally, the consultation including questions seeking stakeholder feedback on the climate-related work as it relates to supervisory guidance. We received more than 130 responses from stakeholders, and we want to thank you for your engagement and valuable feedback. The responses generally supported the proposed changes to refer to climate risk within the ICP introduction with suggestions to refine the drafting and move the location of the proposed text. The responses were also in favor of making changes to the existing supporting materials related to governance, risk management, and internal controls. Those are ICPs 7 and 8, to provide further guidance for supervisors in selected areas such as clarifying the link between climate-related considerations in variable remuneration, strengthening the role and expertise of the board, and emphasizing the importance of forward-looking assessments of climate-related risks. Further, the responses were supportive of including considerations related to transition planning by insurers with the overall climate-related work program of the IAIS. The IAIS is considering the comments received in its ongoing work. The draft revisions of the ICP introduction will be further updated for adoption by the end of 2024. The existing supporting materials relating to governance, risk management, and internal controls, ICP 7 and 8, and the 2021 application paper on supervision of climate-related risks in the insurance sector will be updated and included in the third public consultation that is expected to be published in March of 2024. And there was also broad support for the IAIS to explore the role of supervisors in relation to transition planning. The IAIS has been engaged in the UNDP Sustainable Insurance Forum on this topic and will consider potential collaboration in 2024. We will now move to the main part of the agenda on the first draft application paper that was issued on climate risk market conduct issues in the insurance sector. I'd like to invite Marco Traversa from IOPA to take us through the presentation. Marco has led the internal IAIS drafting team. Marco, the floor is yours.
Thanks a lot, Beth, and thanks a lot for the introduction, and good morning for those in the United States. Good afternoon and good evening to the remaining participants. What I would like to guide you through today is briefly what is covered in the market conduct application paper, which has been published for public consultation. This paper aims at supporting supervisors in their effort to identify instances of potential consumer unfair treatment that can emerge because of sustainability consideration. In particular, the paper focuses on instances of unfair treatment relating to sustainability-focused product, what we would call greenwashing, and also possible instances of unfair treatment because of natural catastrophes and nat cat protection product. While the paper mostly focuses on ICP 19, which is the Conduct of Business Insurance Code Principles, it also highlighted that ICP 21 can be relevant when certain facts, certain claims can indicate a behavior that goes beyond pure misconduct and pure misleading information onto fraud. Finally, the paper, beyond identifying what are the issues and providing some recommendations, it also includes some examples of what certain jurisdictions have carried out in order to provide support to supervisors that want to adopt similar supervisory practices. Moving on concretely on what is covered in the paper has a section which mostly focuses on greenwashing. And in particular, it provides a definition of what could be greenwashing, and it highlights that generally there needs to be a definition and criteria for sustainability claims, which need to be clear, fair, accurate, and not misleading. In relation to this, it goes into more detail and it highlights that if policyholders have certain preferences in relation to sustainability feature of products, and or if insurers, they promote their sustainability profile or the profile of their products which have sustainability features, they need to make sure that they take into account the sustainability preferences of the policyholder as part of the product design and also as part of the suitability and product advice process, and also that they need to make sure that the claims that they make, and the claims can be in various forms. It can be through marketing and advertising materials. It can be in relation to contracts, terms and conditions, but also it could be on website or more broadly on corporate reports. They need to make sure that these claims are accurate and not misleading, and that they are up to date, so that they reflect the overall sustainability profile of the insurers, of the product, and they also take into account of recent development. Finally, this first part of the paper highlight that when information is provided to policyholder in relation to the sustainability factors and sustainability features of the products, also this information needs to be accurate and also needs to be provided in a way that allows the policyholder to make an informed decision. For example, the paper highlights that the sustainability features of the products should not be overemphasized versus other product features. Or it also highlights that this information needs to be given in time, in good time, before the conclusion of the contract, so that policyholders can take into account this sustainability consideration when deciding to buy a product versus another product. The second part of the paper relates to possible unfair treatment that can emerge because of natural catastrophes and because in the way in which certain products might include or exclude natural catastrophe protection. This paper mostly focuses on the protection part, this part of the paper. And generally, what the paper highlights is that products need to be easy to understand, and they need to use plain language. In particular, the way in which documentation, being this in marketing and advertising material, being this in standardized disclosures such as key fact statement or key information document or insurance product information document, needs to use plain language and need to make sure that the key information about the coverage and about the exclusion is provided to consumers. It further clarifies that the understanding of exclusions needs to be tested, in particular vis-a-vis the consumer needs objective and characteristic, in the sense that if a policyholder is seeking protection for a natural catastrophe or for certain climate-related peril, the testing is to make sure that the policyholder, or in this case the target market, the hypothetical group of policyholders, is aware that certain aspect might be excluded or that certain specific situation might be excluded. For example, flooding might not be covered for people living on the ground floor or on the first floor. And finally, in relation to the information provided to the customers, the paper highlights that supervisors need to make sure that advice is provided in a transparent manner, in the sense that the needs of the customers in relation to natural catastrophe protection need to be taken into account, and the advice process needs to clarify whether certain events are included or excluded. In relation to affordability, the paper highlights that there might be certain issues for consumer not buying natural catastrophe product or not being sure about what is covered in their product because the pricing, the fees and charges might not be transparent or might not be easy to understand. And so the paper highlights that as part of the pricing process, the supervisors need to make sure that insurers and intermediaries take into account the consumer understanding and the consumer knowledge and make sure that the price, the fees and charges are clear and easy to understand. The paper in particular provides possible action that can be taken, such as certain standardization of terminology or standardization in the way the price is presented and the fees and charges are presented. Finally, still in relation to the sale process, the paper highlights ways to facilitate access, so possible consideration on how, from a market conduct perspective, the insurance protection gap can also be closed. In particular, it highlights that consumer should be made aware of the risk that they are facing and also of the benefit of coverage. It provides some consideration on how this risk awareness can be carried out and can be implemented, including making sure that teachable moments are solved, such as the registration of a property, the buying of a property. So making the consumer aware in this point in time that they are at a risk of different natural catastrophe and that there is some coverage that is available to them and what type of coverage. Finally, the paper covers the last part of the product life cycle, which is the timely and fair claims handling. In particular, it highlights that when natural catastrophe materialize, consumers can be in a very vulnerable situation. So it is important that claims are handled in a timely manner. This includes, for example, trying to respond fast and try to respond within clear timeframes, and also ensuring that the paid out is in clear timeframes. But it also highlights that the claims handling need to be fair in relation to in relation to the situation in which the consumer is. For example, the paper highlights that consumers should not be asked to provide documentation that they might not have easily available because they had to flee their home or because they had to leave their property. And also it highlights that consumers should not be asked over information that is not available or that they cannot easily access because of the situation of vulnerability. This is what the paper covers. It goes into detail of different recommendations which explore different aspects of ICP 19 and also tangentially ICP 21. And what we would like in terms of feedback, we have some consultation questions that have been put in the paper. And we would like, of course, general feedback on the paper, on each section of the paper. But also we would like views as to whether the draft application paper provides sufficient details to be a useful tool for supervisors and insurers. In particular, it provides detail on how sustainability rated claims can be made without incurring into the risk of greenwashing, but also on what are the supervisory expectations to make sure that consumers are fairly treated vis-a-vis their insurance products and services when natural catastrophe materializes. And the other feedback question that we're seeking is that if there is any additional work that the IAIS should be undertaking in relation to climate risk and market conduct in the insurance sector. And with this, I conclude my intervention, and Beth, I give the floor back to you.
Thank you very much, Marco. Again, anyone with questions, please put them in the chat, and Marco will be on the call to address any questions at the end along with our other presenters. So now we will hear from Alex Curtis and Tom Perkins from the Bank of England, who are co-leading the climate scenario analysis workstream. Alex and Tom will give us an overview of the second draft application paper that was issued on climate scenario analysis in the insurance sector. We will then, as I just mentioned, turn to questions from the audience. Alex and Tom, please proceed.
Thank you, Beth. The second application paper, can you hear me okay, Tom? Can you give me a... Yeah, perfect. The second application paper focuses on the use of climate-related scenario analysis by both supervisors and insurers to understand the risk to which the insurance sector is exposed at a micro and macro prudential level. The paper considers why and how climate-related scenario analysis should be used and the extent to which stakeholders can overcome some of the shortcomings of existing methods for assessing risk. In particular, the application paper covers four main areas as shown on the slide. First, it looks at the differences between scenario analysis versus stress testing and examples of climate risk that can be assessed using scenario analysis. Second, it looks at scenario analysis, objectives and design. And third, the standards set out in the Insurance Core Principles, ICPs, in particular number 24, macro-prudential considerations, and number 16, scenario analysis to inform the assessment of insurers' risk management and governance. It's worth pointing out that the application paper does not consider the development of climate scenarios themselves, but the IAIS will continue to input into the work of scenario designers, such as the Network for Greening the Financial System, NGFS. Next slide, please. Focusing on scenario analysis, objectives and design, the paper describes how scenario design should be driven by the objectives for which the scenario analysis is being undertaken, as shown by the red box on the slide here. There are then four main design considerations or decisions. First is scenario selection, as shown in the yellow box. Users can choose between using ready-made scenarios, such as those developed by the NGFS, or modifying ready-made scenarios, or alternately, another approach might be reverse stress testing. The second design decision is time horizon and the interval of analysis. Each time horizon, whether short or long-term, has relative advantages and disadvantages, and the choice should be driven by the expected purpose and intended outcome of the scenario analysis. For instance, short-term horizons are pragmatic or could be pragmatic for capturing transition risks with less uncertainty, whilst longer-term horizons could be more insightful when assessing physical risks. The third decision is balance sheet choices, in particular, whether to use a static balance sheet where an insurer holds their portfolios constant over time, or a dynamic balance sheet, which allows for the inclusion of management actions in the scenario itself. Fourth, and finally, is decision on whether to use a top-down versus a bottom-up approach. This is whether the analysis is primarily run top-down centrally by the supervisor or bottom-up by participating insurers. This brings trade-offs between the ease of implementation, consistency, comparability, and the granularity of outputs. Thank you for listening. I'm now going to hand over to my colleague Tom for the second half of the presentation on the application paper. Thank you.
Thanks very much, Alex. So, as discussed previously, climate-related scenario analysis needs to be considered in light of the standards set out in ICP 16 and ICP 24 in particular. So, just to go through ICP 24 first as an overview, this covers the idea that the supervisor identifies, monitors, and analyzes market and financial developments and other environmental factors that may impact insurers and the insurance sector. And the supervisors go on to use this information to identify vulnerabilities and address, where necessary, the build-up and transmission of systemic risk. So with that in mind, the application paper here is specifically looking at this from the perspective of implementing climate-related scenario analysis. So for systemic importance, this is considering the benefits to both firms and insurers, where there can be collaboration, both nationally and internationally. And it can be acknowledged that in particular, this is of interest for internationally active insurance groups. There are opportunities to use scenario analysis for addressing protection gaps, and this is from both a prudential and a conduct regulatory view. And it's notable that dynamic balance sheets and collective management actions offers a view henceforth into the pricing and availability of cover. For supervisory response, climate-related scenario analysis can be used as a platform for further investigation and to assess macroprudential impacts when harmonized disclosures can be applied, and the International Sustainability Standards Board is an example of an opportunity for that. And finally here, in terms of transparency, where results can be validated, clearly transparent reporting can therefore drive advancements across the industry, and there are benefits to becoming more transparent over time where this is possible. So that's ICP 24, moving on to 16. So to set the scene on this one, this outlines that the supervisor requires the insurer to establish within its risk management system an enterprise risk management or ERM framework for solvency purposes to identify, manage, report and measure the insurer's risk in an ongoing and integrated manner. So again, from the perspective here, thinking about climate-related scenario analysis, the own risk and solvency assessment, or ORSA, is noted in general to be particularly useful for ERM. And the application paper outlines how climate risk can be a key driver to be considered in an ORSA assessment. For integrating climate risk into existing frameworks, scenario analysis can benefit the approach taken by firms across investments, assets, and underwriting. And in particular, this can include addressing knowledge gaps, exploring tipping points, and quantifying both direct and indirect impacts of climate change. And lastly, it's noted that this can feed into the risk appetite statement process and review, and that the findings from any climate-related scenario analysis should be communicated to and discussed by the board, feeding into broader board accountability. So that's outlining the scenario analysis and how that is feeding into the ICPs 16 and 24. Similar to the previous presentation from Marco, these are our consultation questions, and we would be interested in any general comments, as well as addressing some of these specific points. And then just a reminder that this is feeding into the more comprehensive package of climate-related risk material, as Beth outlined previously, and this is all in the guise of promoting a globally consistent approach to addressing climate risk. Thanks very much, and I'll pass back at this point.
Hannah, I thought you were going to take the question.
Yes, thank you very much, Beth, and thanks also Alex, Marco, and Tom for your introductions, which I think were very helpful. Hopefully for all the attendees to hear a bit more background on the purpose of these papers, and also what are the focus areas of the feedback that we are looking at from all of you. So as a reminder, you can send in your questions using the Q&A function on WebEx. You can type in your question there, and kindly type in your question to all panelists so that all the panelists can see them. We already have a few questions coming in, so I will just read them out, and I will address them to the relevant speaker. Although actually the first question that was asked is something that perhaps myself as the Secretariat can best respond to. The first question was a factual question to remind the audience on the actual definition of supervisor. So we've been talking about supervisors many times in this presentation, and who are we actually referring to is the question there. So with supervisors, we are referring to insurance supervisors and regulators. So within the IAIS terminology, when we also talk about our members are supervisors of the insurance industry, also regulators, so setting the standards for the insurance industry. And this includes all types of supervisors. So it may be market conduct supervisors, macroprudential, microprudential supervisors. Depending on the jurisdiction, this may be one or two different organizations in jurisdiction. So that is what we mean with supervisors. Then another question that was received was related to the paper, Marco, that you presented. So this question is around the coverage for NatCat events, and if the paper also discusses issues around when it's not the private insurance sector that is providing NatCat coverage, but for instance, in cases where there is a possible public backstop, or if there are other mechanisms where the government is somehow involved in providing some kind of insurance or maybe reinsurance for certain coverage, and whether or not that's covered in the paper.
Thanks a lot, and thanks a lot for the question. So the ICP 19 application paper generally focus on situation where a consumer have a private insurance coverage that might or might not cover climate-related peril, and they might find themselves in a situation of a climate catastrophe, or having to submit a claim following a climate catastrophe. So to the extent that there is a government backstop or some public-private partnership that facilitates the provision of insurance, but this insurance is provided on a private basis, then it's covered in the paper. However, if it's the government that provides the payout or is the public entity that provides the payout or the claims management, then it wouldn't be covered in the paper.
Thank you very much, Marco, for that. The next question I see here on the list is related to the scenario analysis paper. And whether Alex or Tom, you could explain a bit more around whether you see any differences between scenario analysis for banking versus scenario analysis for insurance, and if so, what are those differences?
Yeah, happy to take this initially. So I think first of all, it's worth setting the scene that banks and insurers are are fundamentally coming across scenario analysis and thinking about future climate projections from the same starting point in a sense, and looking at using the same tools. And so if we look at the Network for Greening the Financial System and the scenarios that have been developed through that forum, we can see that that is standardized across the financial institutions of banks and insurers. Similarly, that there are other initiatives and attempts to align the approach, at least conceptually, across, and so we see that as well with the likes of the Climate Financial Risk Forum and others as well. I think where there is divergence is in terms of where banks and insurers have started from more individually, and that largely is relating to firstly their exposure, and secondly the data that is available, and that can be considered for all of physical transition and litigation related climate risks. So conceptually the approaches are from the same standpoint, but in reality there are differences in what has been tackled first, and that's largely reflecting the differences in exposures to different climate risks.
I just jump in to add to that, if that's okay. But thank you, Tom. I think that was very comprehensive. I just wanted to flag that obviously the application focuses on scenario analysis from an insurance perspective. But I would kind of argue, and I believe that many of the considerations outlined in the paper are still relevant and applicable if you were thinking about doing scenario analysis for banking. For instance, the fact that scenario design should always be driven by the objectives of scenario analysis. I think many of the principles are and should be applicable across both.
Thank you both. And I think that the paper also acknowledges cases where perhaps there would be scenario analysis conducted by a supervisor that is responsible for both sectors, right? And how that could be done practically. So that's also acknowledged in the paper, if I'm not mistaken.
Correct, yes.
Thank you. Okay, so I think at the moment I don't see other open questions, so I'll just pause for a bit to see if there are other questions that attendees would like to ask us. So I'll pause for a little bit, and I'll come back to you soon in case there are other questions. So I think it doesn't seem to be the case that there are other questions from the audience. I think I gave enough time for people to to find their keyboards and typing in the questions. So with that, I would just want to remind everyone of the deadline that's also currently on the slide. So we have approximately 90 days for these type of consultations. So the deadline is the 23rd of February. Midnight European Central Time, and if you scan the QR code here, you can go straight to the consultation page on the website, or you can go to the IAIS website directly, and you will find it there. We have two different consultation tools for the two papers, so you are all welcome to respond to both consultations, or only if you're only interested more in the scenario analysis work, or only the conduct work, then you can also decide to only respond to one of these consultations. So you can find all the details there on the website, and we thank you very much for your attention today, and for your questions, and look forward to connecting again with you in the new year. Thank you.